Very good morning, ladies and gentlemen. Uh, we have a very distinguished panel. We have two co-founders and one man who funds most co-founders and ensures that there is fiscal discipline. And as we know, this summit is all about retention simplified, and we've been moderating panels over the last 2.5 years. The frequency has just like increased a lot, but this is by far the most simple topic that I have seen. So retention simplified, is it vanity metrics or real metrics? So without further ado, since these panelists have already been introduced, we can hear from them what cuts for you the most. Or is it based on, what stage of the business are you in?
Good morning, everyone. My name is Karan Chowdhury. I'm the co-founder of a D2C brand called Skin Science
I
India.
think we need to up the volume a little for Karan especially.
Do I need to speak louder or can everyone hear me? We're fine? Good morning, everyone. My name is Karan Chowdhury. I'm the co-founder of Skin Science. We are a D2C brand in the health and beauty segment, predominantly selling online on the e-commerce channel as well as our own website. Matrix's growth, I think this is something which we have obviously been following for a very, very long time. But just to answer the question upfront, I think it's very, very different for very, very different companies at different stages of the businesses. Probably the most easiest matrix among all is CAC, right? I mean, you just say CAC is lowest, you don't need any other matrix, and then you're pretty much done. But I don't think that's what happens in the real world. But it's not only one matrix for us which makes us a company. There are three main parts, which is the awareness stage, the consideration stage, and the bottom of the funnel, which is the conversion stage. And every single part of your company has a different matrix to follow. And only when everything works together is when you get the final output. So it's very hard to say that there's just one single matrix, but for sure that there are lots of matrices which are there.
Hari, over to you.
Hi, good morning, everyone. Happy to be here. So I'm part of DSG. We are a fund that invests in consumer brands, started back in 2012, invest in India and Southeast Asia. And the stage we come in is anywhere from inception to Series A. And we invest in online and offline brands. For the first 6-7 years of existence, D2C was not even a term. When it comes to metrics, at the time we invest, the biggest consideration for us is the founder, and there's typically not much data, so to analyze, etc. So it's largely a call on the founder and whether we think the founder has an unfair advantage to build a category-defining brand. And it's after our investment that we work with the founders to help them get to what we call the PMF stage, whether they're able to get to product market fit. And there we look at three things really. First one being retention, both in the online and offline world. And again, don't want to get into, make it super granular, but the high level idea is just to understand whether your customers are coming back to purchase your product after the first transaction, right? It varies by category. We have a mattress brand where the purchase cycle is 10 years, but they also sell pillows. So, you can target customers within a year, etc. But, the high level objective being, whether you're able to demonstrate that your customers are engaging with your brand beyond the first purchase. The second aspect is really around unit economics. We are very fundamentals focused. So, it's about whether you're able to demonstrate that, you can build a business sustainably without over-depending on investor money to scale up, etc. And the third one is really the brand, which is super important for us. Given we're consumer investors, the brand is typically the biggest defensibility for most of our businesses. So, there are metrics like NPS scores that we track. Okay, I didn't realize that. Okay, I hope you guys heard most of what I spoke. I genuinely don't want to repeat all of it again. So yeah, I was on the topic of brand, and there, the metrics we look at is scores like NPS score, And the other interesting one that our founders have started using of late is something called the Sean Ellis test. The NPS score tends to be a lag indicator, whereas, you can Google it up. The Sean Ellis test is more of a lead indicator and gives you a very good sense of, the customer satisfaction and love. Yeah, I think. Yeah.
Brilliant, yeah. Thank you so much. Over to Revant.
Morning, everyone. I'm Revant, co-founder and CEO at Mosaic Wellness. We are a 2-year-old business. We run 2 health tech platforms, one for men's health, which is called Man Matters, and one in women's health, which is called Be Body Wise. Before I sort of go into the topic, would love to understand a little bit of the audience split here today. How many founders and operators? Okay. Investors? Okay. Okay, only 1 or 2. That's fine. No, you got to be careful, right? What you say sometimes. So, and the rest I'm assuming is enablers on the ecosystem. Cool. So, very interesting topic. I think it's become quite vogue anyway. I think every day on Twitter or yesterday there was an article on money control. And suddenly, because the funding environment has shifted, there's a lot more talk about fundamentals and basic metrics, and whether what we were doing in the last 2 years was more vanity than reality. But overall, I think it's a very tough line to balance on. And because a lot of you here today are founders and operators, do understand that if you want to play in the ecosystem and create a large business, you do need access to risk capital for that. And risk capital usually comes in when they're also looking for highly rewarding outcomes. Highly rewarding outcomes do happen when there's a very large size business. Large size businesses do need some risks to be taken at different points of time. So if I look at, and if I look at my journey, I was an operator for almost I was an investment banker raising startups, help capital, joined a startup when it had got its seed capital from Sequoia, and then spent 6 years there, taking that company to almost $500 million, and today it's a unicorn. Then became a VC, was providing the risk capital, and now I'm an entrepreneur again. And if I see that journey, it's actually a balance of both that you need to figure out, right? And nothing is vanity. I mean, I have a very different take on this topic. The chase to GMV is actually not vanity, but maybe you need it in the first 2 years when you want to really showcase that you can capture a large part of the market. So different stage businesses will need to chase different kind of metrics at different points of time. And maybe during the course of this discussion, we can touch upon what stage of company should be looking at what kind of metrics. And in the end, the North Star metric every year will change. For a consumer brand, because I think that's most of the panel here today. In the first year, what does constitute product market fit? And this is an enigma, by the way. That word product market fit, nobody has ever till date been able to give me a very clear objective number that says, okay, you have product market fit now, right? So for some, the definition of product market fit could be category share. For some, it would be NPS. For some, it would be retention. For some, it would be zero CAC. You just look at these different markers, and every kind of businesses needs to figure out what is it that works for them, right? So we can take some real life examples as we go along. But at least my view is that I think this is a demarcation that we create so that we can try to build a structure around. There is a method to the madness.
And for panels like these to look a lot more enriching, right?
That I don't know. But at least for, I mean, it has to make sense for enablers like WebEngage also to build some clarity around
I'm
it.
sure there is a lot of clarity that's going to emerge from this panel as we move ahead. But just to kind of lighten things up a little, okay, for the same organization, can 2 different metrics be at play? At the risk of sounding politically incorrect, would vanity metrics be more relevant to, say, the women's side of business, and would real metrics be more relevant to the men's side?
Yeah, so more than consumer category, it's also stage, right? For example, let's take the case of women's health. So in women's health, we play in 3 large segments. There's skin health, which is largely acne. There's hair health, which is largely hair loss. And there's PCOS, okay, menstrual health, which is largely PCOS for us. Now, PCOS as a category has not been created in India. Right? There is a massive latent demand because there will be a lot of news around that will say that, hey, 40% of women in India have PCOS. But where is the category? Now, the way industry works is, hey, this category is $100 million in size, it's $1 billion in size, etc. How do you define this category? So what metrics should we track to define that whether we have product market fit in PCOS as a segment or not, right? What metrics do we define? Hair loss is a very large market, already proven. Now, the PMF definition of the metrics that we need to track there could be different in that case. That's what I'm trying to entail, right? It all depends on, are you in a category that doesn't exist? You're in a category that is early, the category that's maybe in the middle and needs some amount of investment by all incumbents. Very large category where you want to create a mark, then you will go with something very differentiated, right? For example, if I look at any business that has massive network effects on distribution as a leverage, for them, GMV is an absolutely right metric to track because all they are trying to do is capture the entire market with network effects where nobody else can get in, right? And there are businesses that exist. I mean, I could argue that people say consumer brands don't have network effects, but I could argue that because Wow has they have the bestseller ranking on onion seed oil and apple cider vinegar shampoo, for someone to displace them from the bestseller on Amazon is going to be very hard, right? So chasing that bestseller ranking, in my view, could be a metric, and you could be losing money in the beginning, though they didn't, I'm sure. But today, someone may try to take that as a strategy, right?
Hey, brilliant, yeah. He's actually playing the role of the moderator since he's like set the flow happening. Just to take it to you, okay, so in his business, since these issues are far more deeper, the consulting would be happening and so on, are they able to capture a lot more data than your sector, for example, and where anybody could be kind of interested in, say, a serum and say that, hey, I want to try this out. So can you take us to that? And does that affect the quality of the metrics that you capture or you look at? Yeah.
Hello. I mean, data is pretty much everywhere, and it doesn't really stop for who are you, which industry you are in. It's just a question that how are you going to go get it? And the biggest challenge is how do you get it? And for us as a company, it was a serious challenge because while we were a consumer company and while we started selling on our own website where we had the best quality data, we understood why a customer would come, when would they come, what is the conversion cycle, how often do they convert, which other product do they take along, and that's where we started. But the day we started getting more aggressive on marketplaces and we went into a complete black box because you do not get data from there. Things got even worse when we went offline, when we started in the retail and the brand is pretty much available everywhere. That data then becomes very hard. And then you have to start seeing how you collate it. Right now, the biggest place where we are hiring is data analyst, and I think it's the most important. It's not only with us as D2C brands. I think D2C as a word is going to pretty much go out, and it's going to be more or less digitally first brands which are actually going to be available everywhere. I think that's going to be the new mantra. But along with it, it's basically how you collate the data. And while a digital brand is going to first come and say that I have all the data, eventually in the long run, it may not be the most sustainable. As you actually start getting your wings everywhere, you are going to start looking at a lot of traditional ways. But then you're going to try to say that how do you go and disrupt the traditional ecosystem and try to get that more digitally enabled so that data can eventually flow back. Quality of data is right now a work in progress. It's not the best as how it used to be. There is black boxes, especially when the company is scaled to a certain level. But over a period of time, as we see that there's a lot more new technology which is coming in the offline retail sectors, we are getting to know in each and every store which is there in the retail that how many products are sold and when do you have to replicate it, or certain products which are working in certain geographies. I think the entire ecosystem has evolved into a lot more matured place when it comes to data and data quality. 2 years back, it was pretty bad. Right now, I think we're going in a better direction.
Hey, but tell me, just sorry, there's a follow-up question. You know, when you say that, you know, the marketplaces are actually kind of a black box, but if they start contributing to a large share of your volumes, would you as a founder then risk saying that, yes, these volumes are going to help my business? So if there's not enough data or measurement coming in, it's still okay, I go and pursue that.
So I think,
Is there a risk?
no, I again think it's where you are in your journey of you being a company, right? If you're a new company just about starting, and the advantage what a D2C company has is the fact that you can launch a product, get information about that particular product, and act on it before you actually make it mass. Uh, if you're in the early phase of life, then you don't look at marketplace strategy. That's the second part. You look at a very, very strong D2C strategy where you communicate with the customer a lot better. You try to give a call to the customer immediately as you have actually sold the product, and try to get a lot more information to at least try to make it better. Once you're fighting with the big boys on a marketplace, it's a completely different game, and you have to be there. I was speaking with Hari just some time ago. Customer acquisition costs are just going off the roof. It's extremely important for your product to be available in every single channel. We were very proud of calling the word D2C some time back, but D2C by itself will not make you a brand which is going to be available across the country. As a brand, and especially consumer, and I'm sure every single brand will be doing that, they will have to be at every single touch point where the customer is. So it's not that you can just take one. You will eventually have to be where the customer is, and I think that's the only advice which I can give anyone, that where a customer is shopping, your brand needs to be available there.
So to bring Hari into the conversation, is growth at all costs still a relevant approach?
Well, it was never a relevant approach. And, at least, as I said, given that, we're a fund that backs offline brands, online brands, etc., we tend to be a lot more fundamentals focused. But, as Revant said, this growth at all cost is somewhat it's a word used to describe many things. And it's also very context specific. Again, if I just zoom out, my view is as long as you're doing anything in a thoughtful manner, it is fine, right? A lot of business models that are classified as growth at all cost business models have a method to what they're doing. As I said, there are really, if I were to try and put a structure around it, for us, there's brand, which is to do with the customer, and then there is business fundamentals, right? And a lot of these growth-obsessed models focus primarily on the customer, and sometimes they play in categories with a winner-take-all sort of, outcome eventually. So when you're pursuing business models in those segments, you have no choice but to grow really fast and be the last man standing, right? But the good thing is, in consumer brands, that's not the case. You can carve out a niche for yourself and build a really beautiful brand and an enduring brand at that. I joke about it, with our founders that blitz scaling to unicorn outcomes is not the highest calling for mankind. You can build a $300, $400 million business, own 60% of it, make a lot of money for yourself and investors, right? So there are various ways to build businesses, and yeah, as long as you're thoughtful about what you're pursuing and have factored in pros and cons and ensuring that you're playing to your strengths, I think you can pull off anything. So the only other thing I want to add is, if you are pursuing that growth and customer first playbook, then the founder should be super confident in their fundraising skills, storytelling, etc., right? So yeah, there's no one right answer. You just have to play to your strengths and be thoughtful about it.
Okay. But for an early stage kind of company, wouldn't be wouldn't it be kind of logical to pursue growth at all costs so that it comes into the line of sight of people like you, so that you obviously want to invest in a brand that you've heard of in some way rather than a complete stranger?
Not at all, right? I'm just coming here from our offsite in Sula. Deepak, our founder, was the first investor in Sula, and it's a 20-year journey, right? So, again, there are investors with different considerations.
But for people who are old enough in this room, 20 years back, many of us had heard of Sula.
They created the category and they own, their market share is 65%. So, again, being consumer investors, our view is that brands take time to build. And in a way, it's the reason for existence for a fund like ours, right? Because the tech playbook, we believe, doesn't work for, most consumer brands, because brands do take time to build, and it takes time to build that customer love, win the trust of the customer, etc. So I can speak for DSG. For us, growth at all costs is something we're not comfortable with. And we tend to over-index on, whether the founder can build an enduring brand and has a, fundamentals first approach to business. But as I said, not being judgmental, but, this is what we know we've seen play out really well in our portfolio, be it a Sula or Viva, so yeah, that's sort of our dispensation.
Hey, thank you for that. Yeah, please.
So I think you're right, that works for DSG, but if you ask, because there are so many founders and operators here, and I'm sure to be founders, one of the things that every founder aspires is to raise risk capital, and that's why I started with that, right? Is risk capital, I think DSG is one in a few who thinks that this is how brands should get built. But in the end, you would do what, 5, 6, 10 companies a year, right? There are like thousands of companies starting every year. So they can't aspire to be only part of those 6. So they need to look at alternate pools of capital as well. And if you look at most pools of capital that are available as risk capital today, everyone wants to see growth as the starting point to, because that's the only marker that one would understand, right? And here's a large private equity, and I'm sure once there is, sometimes there's a boardroom talk, hey, let's think about the next round. And in the end, the question will be, have you grown since the last round, right? That's the first question that comes. Then the other metrics come in. So I think growth at all costs is a little abused term. But even if you have the best NPS and the highest customer love, but for whatever reason your growth is not that great, in the last 10 years, I have seen a lot of such businesses not get capital, right? So is it a little bit of the market situation where risk capital availability, the basic requirement is always, hey, how fast are you growing? Because that's always a precursor to how large you can become, which is a precursor to how much returns one can make, right?
I think, the dimension you didn't speak about is the time dimension. I think the velocity, the historical velocity is used as a proxy for how soon you can, get to that large outcome, right? As I said, from our standpoint, we're not too stressed about the time dimension. If you sort of are fine as a founder, if you love what you're doing and are willing to do it for like 15, 20 years, you're right, that's not most of the market. But there are investors that like those kind of founders and those kind of
Very
journeys.
few, no? But
no, that's
15
true.
years, like, I mean, I don't know how many founders here have an SHA. What is the exit clause? 4 years, 5 years? Like, no investor signs more than a 5-year exit clause.
No,
right?
correct. But there are investors that want a 10x in 5 years, and there are those that want a 2.5, 3x, right? So I'm talking about the investors.
Very few, no? But
I agree. That I'm not disputing. So, as I said, it's important to understand the pros and cons, and yeah, the fact is there are few investors that think like this, but at the same time, the other option is driving to profitability, right? You can just eliminate the need for an investor. Like, wow, I don't know the revenues you hit without external capital, but yeah, that is always an option. Why do you always need an investor to support you, right? And yeah, that's another way to think about it. Just drive to profitability. You enjoy what you're doing. You don't care about getting to a unicorn outcome in 5 years. Life is still good. Not for everyone, but yeah, it just...
Please
Since we're
go
on
ahead.
this topic.
Yeah.
So we did around 280 crores revenue without raising.
Please keep
So,
the mic closer.
Yeah, so we did around 280 crores of revenue without raising funds. So obviously that's definitely a possibility, but I just want to make it very simple because it could be lost. And growth at any cost is a word. There should not be no growth at any, which should not be happening. I think growth has to be there, and it is going to happen at any cost, because if you don't have that, trust me, you're done. So it cannot be no growth. I think that's something which we first need to think. The second part of it all is you do need to think in that direction, but it eventually has to start going to sustainable growth at any cost. Any person coming with risk capital is saying that I'm putting in money right now. How is that going to grow in how much time? And trust me, if the growth numbers are looking very, very small, no one's going to fund you the next round around. It's happened. Early stage, I agree. You're looking at fundamentals, you're looking at cost matrix, you're looking at, is your repeatability there, is everything there? That's great things at an early stage. And it's very, very important for everyone to take those basic things to at least reach a level of profitability. I think Hari was explaining that. I don't know how many of you guys have actually reached this level first, at least looking at a profitable level. Then it's okay to start saying, how do I take it to the next level? How do I decide to acquire a lot more new customers? How do you start going to above the line advertising? When you start doing TV budgets, when you start doing samples, those kind of money is just going to go off the roof, because you're trying to reach to a completely different set of audience who is not there via a straightforward performance marketing campaign which is there on Facebook. And that time, that's going to be expensive. So that kind of growth is for another level. I even told him that I think what's the most important thing is, there is how much ever money you may have in the bank, there is certain matrices. You cannot breach them. If you are within the matrix, anyone will like to back
Okay,
whoever's the founder.
would you like to go deeper into it and actually list down what are some of those things which you should not breach at any cost?
No, I think again it's very, very different for different places.
Yeah,
Now,
but how does it work in
if I
your
have to,
space?
so I'm going to not take it at my place, but I'll probably go as a starter. I'll probably go, where was my journey probably 4 or 5 years ago, where it was most important. And a lot of times, or whenever I've spoken with founders, they come and say, okay, right now my CAC is super high because I'm a new brand, people don't know me. My opinion over here goes across to say that if your CAC is high from the initial days, over a period of time, it's not going to go down because you have something wrong with the acceptability of the product. I strongly believe that a customer looking, or the secret of something knowing whether something's working, is initial impulse buy. If a customer is able to buy it initially and you have your matrix in order, that's great. The retention part, since we're in a retention conference, I've not heard anyone really speaking too much about it, so let's get to that point. But the whole scenario is, how often do people come back? How often do they come and choose another product of yours? How often have they bought it again? Have our people given a call to them to see, do they like it, or do they even communicate with us or communicate with the brand? Those are some basic tick boxes which we actually have before we actually move forward. Do they even like our product? Then we eventually started going to a level where we started getting so retention focused that we actually forgot our new customer acquisition. There was a time when we were pretty much having a retention rate of 65 to 70% on our website, and people were coming and saying, where's the growth? You don't have any of your new customers. Problem is, we went so involved into retention that we forgot our new customers. So the whole logic is, retention is probably the most important part, which is there because CACs are extremely going high. CACs are, the new customer acquisition is the growth engine which is there, which is turning out to be super expensive. But retention is that part which actually gets it better. And as you can keep talking with the customer, keep sending them emailers, keep sending them branded retention related stuff, which gets a customer keep thinking about you, right? That definitely helps to keep that growth journey working. So it's eventually.
Okay, this mad rush behind growth, is it also triggered by this entire the unicorns becoming the status symbol. Every founder wants to be seen as building the next big unicorn. How much of that pressure is in the ecosystem?
So we've finally found the most obvious vanity metric that journalists have created, which is...
Well, we didn't create the metric, they put that.
No, I mean, how many times were you covered in Economic Times before you got funding, Karan?
Quite a few, actually.
Achha, okay. Maybe we should wait for the noise. So, I mean,
We got the Economic Times Startup of the Year award bootstrapped.
But that was like what, 4 or 5?
Bootstrapped. Before funding.
Got it. But you are one of the lucky ones who got the award in that sense. I mean, or well deserved as such. But the fact is, you look at any news site today, and all it talks about is X amount of funding raised.
Right.
That's the only news that comes out, right? So, in a sense, I think there are. I think the ecosystem needs to align as to what is more important and then guide the founders into that, right? So if the ecosystem is going to just keep celebrating funding, then people will think that is the measure of success. And which is why people will get more and more aspirational that, hey, I have a great business, but I don't have valuation. If I need valuation, I need to go to VCs, and VCs look for growth. And I mean, it's a spiral. So I could argue that over the last 10 years, maybe it's the overall pressure has been built in by ecosystem, including media. So maybe that needs to course correct.
You also need to keep your PR machinery in check, I should say. There's so much of aggression on that front. It is unbelievable now that you're putting out that point.
But companies raise like once in 2 years, right? But the rest of the time...
but there is a lot of pressure from founders to get visibility even in those in the phase when they're not raising capital, right? Because they always want to be seen there, and they see this as, the coverage is seen as one of those that the unpaid media as opposed to the paid media.
I think I'll tell you why it's critical. Like we never
I think that's a vanity metrics in itself.
No, actually you got it wrong, unfortunately. So, the biggest problem today in this country is 10 years back it used to be risk capital. Now it's not risk capital. Now it's talent. How do founders go out and get talent? Right? You need to be the next big startup that everybody is looking up to. Otherwise, the best talent doesn't want to join you. And this spiral will continue as capital keeps chasing. But in the end, it's not that our GDP per capita is increasing significantly. Right? We keep talking about a $5 trillion economy. But our GDP per capita has been at $2,000 for what, the last 3 years, and every slideshow keeps showing the same thing. And we keep aspiring कि as China will become 4,000 or something like that at some point of time, right? So, देश उतना ही गरीब है, पैसे बहुत आ गए हैं, founders बढ़ गए हैं, talent उतना ही है. So then there is more flight to quality, right?
Yeah,
so I think what we are realizing, not realizing actually, is it's not easier to build just because there's more capital and there's quality talent. Now the fight for that talent also needs you to either grow faster or be in the news, right? In that sense. So, I'm sorry, I don't take this lightly, because in the end a founder's journey is very hard. So you can put all the blame on everyone, but you should be very careful when you say that, hey, founders are very keen to do PR. They are, because in the end talent nahi aayega na, varna kya karenge?
But tell me something, aren't the established ones also facing a talent challenge? Indian IT companies where retention is a huge issue today.
They pay like sweatshops. We don't pay like sweatshops. We still don't get talent.
So I think that's where the brand versus
you have to know. Like in the end, even I know it's changed compared to 10 years back, where hey, TCS is a safe company. So my nephew was in one of these large companies, and I kept telling him that you are so smart. He was like a topper in college, loved coding, and I'm like, what are you doing? You're not coding here right now. Go join a startup. And his mother, who was my first cousin, called me one day and said, why are you filling his head with crap, right? So there is enough of that happening even today. Eventually he did, and now is very happy in a startup.
Where our generation is obsessed with brands and the next gen is probably...
So we also need a brand, right? We need to be in the news so that parents will say, हाँ यार ठीक लग रहा है, चलो सुना हुआ है करके ना.
Okay, to get back to one point which Karan made was about how getting the right retention mix is very crucial to business. So if I can ask you, Hari, would you make some recommendations on this front that maybe 70 is too much, chasing retention, you need to maybe chase a larger size of new customers, or is 70 too little that 90% of your customers should be falling in that retention band and so on?
I had a follow-up on this one. No, I had a follow-up on this one. How do you exactly measure retention in a omni-channel setup? I mean, maybe Karan, you would also, because I sort of keep wondering that when, let's say 40% of your sales is on your website and 60% is a black box, how do you objectively say that this is the accurate retention?
Sure. The way we think about retention, first caveat is it's very, very category specific. There's no one size fits all. You would hear that 3x, LTV to CAC, etc. But the way we think about it is, for each category, you have to look at what the gold standard is. Again, thinking of examples, if you're building a platform, I think the metrics of someone like a Swiggy, etc. is available. If I'm not wrong, it's like 30% customers come back on month 12. Again, I'm just, I don't know if I'm accurate, but it's in that zone. So that's the gold standard you aspire for, and no one gets there, in year one. But, directionally, it's about getting there, in how many ever years it takes for you to get there, right? So I think it's about knowing what the best in class is, and then, planning your journey towards that. And it happens over time. In our brands, it takes 2-3 years to get somewhere close to where the category best is, right? And it's very category specific. I just gave you the example of, a platform play. I think personal care, I'll let Karan talk about it. But coming to offline, the way we...
Hari, sorry. In hospitality, where I think one of the biggest brands is under your OYO rooms, right?
Yeah, we've exited them. So it's before my time. So I really,
Okay,
we exited before I joined.
Is there an average benchmark? Would that be higher than the other businesses that we're talking about?
OYO, I can't comment because, I really don't have the data. But, another hospitality brand we have is Vista Rooms, which is a vacation rental business. It's sort of a full stack Airbnb where they manage homes, market homes, and, it's a full stack offering. Think of Airbnb doing the services for the hosts, etc. So there, we treat it like a SaaS business, because every year you acquire a number of properties, and then you look at how that cohort moves year on year in terms of revenue retention, right? So we expect north of 100% revenue retention in every cohort. What that tells you is that, it's not a leaky bucket, and, properties are not churning out, for you to add more properties to just be where you were last year, right? So, that's just an example in hospitality. Coming to offline, there are two things we look at. One is store velocity, which is the store throughput at an outlet level. And again, it's benchmarking to what the best in class, whether it's an HUL or in your category, whoever is the biggest player, benchmarking your store velocity versus, the best in class in that front. To again give you an example, someone like a Viva, the sauce brand, will be at a 3,000 rupee an outlet. This is a blended number, right? GT, MT, etc. And that's like a metric that we monitor, and we also monitor store cohorts. So every quarter you add distributors, you add stores, and we understand how, the distributor store revenues pan out quarter on quarter, right? Ideally, again, you should, at least retain the revenues that you did in the first quarter, etc. And it's super hard because you have a a well-defined space and only so many products that you can display, it's hard to build your revenues, but it's important to track and ensure that it's not going down rapidly. So these are metrics that that we monitor in the offline channel. And I hope that gives you some sense.
So the question was, if you, and maybe Karan can also chip in, let's say you're a personal care business who has a range of shampoos and oils, and you're selling them on your website, you get PMF, then you go omni-channel. Now, you have shampoos and oils, it's almost like grocery, right? People are coming back every month to, it's personal care, bath and body, etc. Now, when you list on, let's say, Amazon and Flipkart, etc., people start buying from there. Some of your customers will start buying from there. There will be leakage technically on your D2C channel. Now you're not getting that data. So how do you accurately measure the cohorts?
I think that's been the question which has been asked by multiple investors multiple times. And let me put it this way, as our journey, when we were predominantly D2C, we probably had a lot of the retention data and we were pretty much obsessed about it. When we were focusing on Amazon, Amazon used to give us certain data which came out of Pi, which allows you to at least understand what is retention, and probably you can always get data around, because there are ways of downloading an Amazon data which is there. Though they do not give the email address, they give a unique ID to every customer who is there, so you can understand retention over a period of time. But then there is a drop-off and a spillover which happens, and then you start modeling around it. But then from a retention-obsessed organization, we actually threw the number down the drain, saying that now you're opening at a lot of different places, and we completely stopped tracking retention for the longest time because it became very, very hard for us. Not the best approach, highly regretted. But right now what we are trying to do is we have to assume that there are leakages. You cannot get data from a Flipkart, you cannot get data from Nykaa, you cannot get data from your B2B part of the business with the B2C, and you've got to just live with it. If you're going to be obsessed and say that I'm not going to be on those channels because I don't get data, too bad, you're the guy who's losing out. But we are taking simple matrices for every single channel which we follow, and however bad the data is, there has to be a matrix. You have to put a matrix to whatever you're doing in whichever channel which it is, and not just avoid it by saying that it cannot be tracked. So if your retention number actually comes down from 50% to 60% has come down to 30%, it should be tracked, and you should actually even write down why has it changed and what is the reason, so that at least when you're data modeling it, you at least come to know which is what. We even said the same when it came down to offline. How are you going to track retention on offline? Right now, there are tools like Bizom and so on, which are allowing you to understand that which outlet has gone and repurchase that product from which Kirana stores, and you start going down into that level. I completely understand your point. I think this is the question which has been asked by every single investor, every single commercial due diligence that we have actually gone through, that what is your CAC? Like, we are spending across on Facebook, Google, which probably may not be the most economical on your website, but we know that it has a spillover on Amazon. We know that there is a bump up which happens somewhere else. How do you attribute all those things? So company level CAC, channel level CAC, these are questions which are there, but probably people now, at least investors now, understand that your product is available everywhere. 2 years ago, trust me, this was not the case. 2 years ago, the investor really thought that they knew everything, and we don't know what we are saying when it is around. I know for a fact that one investor pretty much rejected investing in us, saying that our retention is pathetic. But he couldn't really understand that our product was actually available across all the channels.
At that time, what was the retention score that you had projected? Or
it was in the range of something like around 25%. And they pretty much said that, oh, it's way lower, because they were seeing digital tech-enabled startups, and they were saying you should be at 60%, you should be at 70%. But what people don't really understand is sometimes your D2C channel may not have the best deals. Sometimes the price sensitivity of an Indian consumer, and especially with Amazon being aggressive, Flipkart being aggressive. Then there's the Paytm mall which came out of nowhere. Now Meesho is coming. Now there's pricing which is not having a parity across. And a customer is going to go and look. And quite honestly, there are even apps in your Google Chrome which has all the marketplaces listed. And if you're on that page, you come to know exactly where is the price going to be the cheapest.
Yeah.
Where is platform loyalty? And what happens if he doesn't want, if he runs out of a shampoo and if he's bought it on Amazon and he actually says, hey, I finished it and I forgot to order. He's going to go to Kirana. How do I show an investor that this is retention, this was my customer? An investor is going to say that's a drop off. A customer has gone somewhere else, which is not fair. But that's a reality of life.
And,
I think we are getting to a point where we are saying retention is a vanity metric.
well, we know.
No, I said very clearly, that every single channel has to have a matrix and everything has to be tracked, however bad the matrix is. But it is very, very important not to get upset by some of the matrices and probably not to revolve your entire business around it. The worst thing what can happen, and which I've seen, is that, and I've seen it with another founder, an investor passed a comment saying that your matrix is bad. He went and stopped doing business and all the other places only did it on D2C just to improve that matrix, but his entire business fell. So it's very important to take business decisions. As long as you do that, and as long as something is tracked, you're fine.
Okay, but since we are into this topic of retention, do we actually differentiate between retention at full price and retention at offers, or is this like, what is full price all about? Because there's hardly anything.
Yeah, I think one of the problems that's happened with the data explosion is that we have started to track a lot of things. But net, I keep telling my team that always look at, so there is something called second order effect, that if I do X, then what will happen, then what will happen, then what will happen. You can actually trace it back as well. If you just look at any business decision or any sort of data, I encourage my team to go back and say, ki ye aisa kyun hua hoga, right? Think about that a little. And most of the data, you may look at 20 data sets, the answer may be only one or two things that you did, right? So instead of getting lost in data, and this is something that I see a lot of young folks now get into that trap. There's no point of trying to dig more and more and more and just go back to fundamentals and first principles a lot of times. And like this is an example, right? Like what happens when the Amazon sale comes in? I mean, it's consumer behavior in the country changes because people wait for those sales for those 5 days. So your retention or your traffic on your D2C site is going to drop. It drops everywhere, not just on including Amazon. People just wait, right? And then there's a hold on those 3 or 4 days, and again there's a lull, right? So, I mean, there's so much happening in the macro that too much data sensitivity is also not good in some sense. And for the rest of it, I'm sure we have platforms like WebEngage to help us.
Amazing. Moving forward, if we had to kind of recommend a runway, what would that be? What's the right?
Runway as in business runway?
Yeah.
I mean, for a founder, it's always infinite. I mean, infinite is the best case to have. Second best option is how long, how much. I mean, in the end, there's a lot of advice that don't raise too much. But in the end, there's always that fear, right? That you don't know how much you may need. Because at least in my operating experience of the last 10, 12 years, very rarely have I seen any plan getting hit on the cost side. Costs always escalate. And there's always, I mean, you may model any kind of growth in your Excel. Very few companies, unless they have spectacularly scalable PMF, will actually beat that. So, usually is as much as possible, but I think it's more a guidance and thing that happens from the VC end versus the founder end.
But is there also the fear of giving up too much of control?
There is no loss of control, no? I don't think VCs like to get in control of companies. Do you?
Absolutely.
There's no loss of control.
Great. I think for us, yeah, infinite runway is the best option. It could mean, confidence in yourself to driving it to profitability. But again, I think our general guidance is 18 to 24 months. You should budget for 6 to 8 months for the fundraise itself, since you hit the market. And, raising 18 to 24 months will give you 1 year for heads down execution, right? Because fundraising, the gentleman here will tell you, is a draining affair. And, it's just important that you have 1 year of, just heads down execution where you're not worried about fundraising.
I mean, the only thing which I can say is that raise funds when you don't need it. I think that's the most important mantra which is over here, because when you actually need it, you're not going to get what you actually are hoping for. The runway, as he rightly said, I don't have to go behind it, but you definitely need at least that 6 to 8 months, because if the other side finds out that you do not have a runway, you're going to be pretty much in a desperate situation to take whatever deal is on the table. So you definitely want to take this thing. But one more thing is, you rightly said that, are you too worried about losing control? And to some level, yes. But to next level also, it's a no, because the more people you have on board also, they also have an equal vested interest of making this extremely big, because everyone eventually has to exit it. And I do not normally see that a VC or a PE is going to actually play very, very bad on you, as long as you don't play bad on it. There are a lot of founders who have taken a lot of this for granted, which may actually be the reason why some of these stocks are. But as long as you are true to what you're doing and follow a good plan, and you stick to your execution, you should not normally have an issue, because everyone's pretty much here for value creation. I think that's the word eventually. No private equity is going to try in their hands to try to actually destroy the value which is being created. They also need an exit. They also need a story. Having a bad story, it's only going to hit a valuation, which is something which they don't want. So I think it's more about ethics. It's more about trying to be realistic with your partners and be honest with them, be truthful with them. And that's sometimes lacking. And that's sometimes where this issue is.
Hey, thank you very much, gentlemen. And I'm sure the audience will agree that it's always better to have 2 moderators instead of 1, because Revant set this up really well. So Revant, Hari, and Karan, thank you very much for these insights that just kept coming and coming that I lost count on time.